Ravi Dharamshi, founder and CIO of ValueQuest, joining in on our conversation. Ravi, so great to speak with you. Finally getting a chance to hear your views on what's been going on. Do you think that now that the Trump trade fears are behind us, what's going to dominate perhaps, and what we're seeing today as well, is fears of an escalation across the border? How big a concern is that for the market right now?
Good morning. Good morning to your viewers. But see, honestly, it's a sad, tragic thing what has happened, and it is going to lead to an escalation in the tensions with our neighbors. But at the same time, purely from a capital markets point of view, I don't think it's that big an event, and we should not be overly obsessed about it. It will dominate the headlines of the white papers, but from the point of view of pink papers, it probably will have a small mention. I mean, a small probability that it blows up into a full-blown war. But even then, I don't think it is going to impact the markets much. Sad to say,
what do you think is spooking markets today? Do you think that after the kind of run-up we've seen, because we saw a very, very good start, Ravi, after the kind of run-up that you've seen, is this a bulls taking a pause, or are there bigger concerns right now till we don't have clarity on what happens over the next 2 or 3 days?
No, clearly, I mean, markets had run up furiously, right? And the market positioning, which was ultra bearish, has now turned more neutralish. So from that perspective, clearly a pause was needed. Had this event not happened, we would have still had markets correcting a little bit. So I will not attribute this to any kind of rise in geopolitical. It is purely markets had run up a lot, and some supply is to be expected. So I would say it's normal course of market action.
Okay. Ravi, good morning. Neeraj here. And I read a view from you a few days back, wherein you mentioned that if the markets would have gone down further, then the probability of making money would have risen to 90% or more. Now, that's turned out to be true. What's here on, Ravi? Now that the markets are no longer at 22, but circa 24, 25, or somewhere in between?
So let me just give a couple of minutes to why I thought that odds were in our favor.
Sure.
Because everybody at that point of time was clearly very worried. The world as we know it is coming to an end, and new economic order is being put in place. And even today, I think big voices like Bridgewater have put out notes saying that this is not a small thing. It happens once in 50 years kind of an event. No doubt about it. It is a big event. We are rewriting the rules of the trade, but I do, believe that the president of United States has a particular style, and there is a pattern to it. It is, you can read through it, that he makes some kind of an egregious, outlandish statement, brings people to the table, negotiates, and gets a good deal. That's essentially his entire playbook is about getting good trade deals. So, and for all practical purpose, it looks like India will be first of the block in terms of getting a deal, and deal might not be so unfavorable for India. So from both perspective, India actually ends up in a better position vis-a-vis. And the main point of friction for them is with China and other Southeast Asian nations, which are conduit for China. So that is where the fight is, and we might actually end up falling on the right side of this equation in the new trade order. So very different views if you are in US. I do believe that from a very longer term perspective, what has transpired, US had become almost 75% of the world's market cap. I think that is untenable and unsustainable. The rest of the equity markets will also now perform, and India will be a beneficiary in that as well.
Got it. Okay, Ravi, you take a lot of bets in futuristic themes, but I believe the ordering and the juggle would have gotten reset because of this tariff announcements as they came in. Now we know that those issues have been dialed down quite a bit from the US end, right? So has it involved juggling the portfolio all over again because of some assumptions that rightfully could have been made at the start of the tariff war? And what is it, where is it that you have the highest conviction? Because the street is very, very divided on a lot of themes. due to the tariff war or otherwise?
So, first of all, I believe we are not yet clear on how this trade war will materialize and what kind of new rules are being rewritten. Only thing what we know at this point of time is that there are certain sectors which are not impacted by the trade war at all. For example, financials, we have seen the kind of rally that this, because it's not impacted by the tariff war, it is totally linked to the domestic economy. And domestic economy actually is now on the path of recovery. Whatever was ailing has now been turned, whether it is government, whether it is RBI, whether it is liquidity, whether it is interest rates, everything is now supportive of growth. So from that perspective, there is a clear winner in the set of companies and industries which are not impacted by tariffs at all. That is one part of this. Second part, in which could be the winners or losers out of this tariff war, I would like to reserve my judgment on that at this point of time. And I would not even like to place my bets. I think what I like to say is that you should take bets regardless of whether that sector turns out to be a winner of the tariff war or loser of the tariff war. Now, if there is an added kicker that the supply chain realignment leads to that sector being a beneficiary as well, that is a great thing. So you should be able to justify an investment without that additional kicker. If that comes in, nothing like it. I mean, I'm just giving an example of, let's say, textile sector. If textile sector looks good, of course, with UK FTA, EU FTA, and if we have some kind of a deal with US, it will be a big kicker for that sector, and that sectors can change trajectory dramatically. But will that definitely be the case? I'm not 100% sure at this point of time. Early indications are there. So that's just, there are some second order, third order implications also of that. For example, where will China supply then? If they are not going to supply to these markets, then where will it go? And can that end up oversupplying our domestic market? So those kind of things one has to worry about. So I would like clarity to emerge before declaring winners of the tariff wars.
You know, Ravi, in terms of clarity, is this an opportunity to buy? We've been speaking over the last 7-8 days or trading sessions with everyone who says it's a buy on dips market right now, and no dip in this sense has presented itself. For those who missed the bus, got very cautious, conservative or fearful with the kind of 6-month downturn we saw. Are we seeing opportunities of buy on dips? And if so, where would you be most excited to see deployment?
So I think first of all, we need to understand that the larger trend, which is still an uptrend in my opinion, is not broken yet. It was a corrective move. Whatever the 6-month we saw was still a corrective move and not a reversal of the larger trend. See, we are at the mid-cycle of the earnings cycle. I don't think the leverage has peaked in the corporate world. Neither has the asset quality. It's pristine in banking system. So this is a little bit of a growth challenge, little bit of a margin challenge, and a little bit of valuation challenge. And that can correct itself over a period of 6 to 9 months with some kind of a correction, which is exactly what has happened. Now, wherever there is no issue, whichever sectors and companies are not facing growth or margin challenges, we'll see revival for sure. Because the factors of growth are also, the lead indicators are again back in favor. So I would say it remains a buy on dip market. The dip turned out to be a much deeper one than more anticipated by most this time around, but it was still a buy on dip. Now, having most of the, I mean, from the bottom, we have recovered quite a bit. I would anticipate that the pace of going up to slow down. There will be some kind of a consolidation. And not to expect returns in the next 3-month time frame, but from a 3, 4, 5 year perspective, I think we are still very much invest in the market mode.
Ravi, you now manage a fair degree of global money, and you'll be speaking to a lot as well. 30,000 crores in the last few days, the highest buy number yesterday since March 27. Clearly, the nature of the global opinion out here is changing. We see it in the sell side notes as well as the advice that they are giving to their global clients. What's your sense? Here on, is global money likely to stay sticky and the inflows would continue into India? Are you sensing that in conversations that you might be having with your investors as well globally?
No, I definitely feel foreign money is going to come in, and this is only the beginning. See, for the last 15 years, there was one trade that was panning out: buy US, and sell everything else, which was being called as US exceptionalism. We come up with these terms every now and then, but whatever might be the case, once all of us knew about US exceptionalism is when the US exceptionalism ended. So every crisis that we have seen in the world in the last 2-3 decades, the rush has been to go to the safe haven, which is US dollar or US treasuries. This is the first time that we are witnessing money flow out of US treasuries and US dollar. What does that tell you? That tells you that the confidence in US as the safe haven is not there anymore. Bond yields have fallen for pretty much every other country. The currency is going up for every other country. So naturally, non-dollar assets will do better than dollar assets. And if that is the case, then money should flow over there. And India will also be a recipient of that. I am not making a case that India will be something exceptional vis-a-vis some other emerging markets. See, it could be Europe that gets money. It could be some other markets also. But India will also get. There was a point in time where relatively India was very, very unattractive. It's not the case anymore. The relative attractiveness of India has come back. See, people say India is quoting at a premium to the emerging markets. Yes, of course. But, it's like saying that pharma is quoting at a premium to metals. Of course, it is quoting at a premium to metals. It's a different kind of a business. So India is cannot be in the same bucket as some of the other emerging markets, which are purely much smaller economy, far lower ROEs, far fewer sectors, more commodity driven. Those kind of things are the reason why India always gets a premium. And also the biggest reason technically is that almost 40% of the float in India is owned by promoters, which is not the case in other markets. So all these factors mean that India will always remain at a premium until at least we see like huge dilution from the promoters or something like that. But until that time, India will always enjoy some amount of premium at least. And so the relative attractiveness is there. At the lows, absolute attractiveness was also there. Weightage in MSCI and other FTSE benchmark and all has gone up for India. So naturally, the money should flow into non-dollar assets, and India will also get its fair share over there.
Okay. Ravi, my final question, and that is, you must be bored of answering about energy transition because it's well discovered, you guys championed it, so on and so forth. What's the next energy transition theme in India? Something similar to that.
So you will have to listen to me for another 5 years probably. This trend is not going anywhere.
No, that we know.
I think it encompasses probably 20 different sectors. So it moves from sector to sector. Today, the two sectors that we do like are the solar renewable value chain and the transmission power value chain. But will it shift to, let's say, some other sector 3 years down the line, whether it could be hydrogen, whether it could be EVs, whether it could be battery storage, all those kind of opportunities are coming up at some point of time. So I don't think we should say energy transition from any point of view anywhere close to peaking. It's a trend that's going to run for at least a couple of decades, and the sectors within that will keep changing. So I just listed out a few ones to you, which I believe are still some time away from becoming investable because the unit economics are probably not in place for hydrogen or for battery storage systems. So once those comes and there is enough regulatory tailwind is when they become investable. But it's okay. At this point of time, they are visionary investments.
All right. Thank you so much, Ravi, for speaking with us. Ravi Dharamshi, founder and CIO at ValueQuest Investment, with some sanguine advice there. Ravi, I don't know if I agree with you completely that there is no concern about geopolitical escalation on the street right now, because if one starts and there will be retaliation from India's end, that's a given, then we don't know where it will go. That street doesn't like uncertainty. So I don't know. We'll wait and see how that pans out.